If even Warren Buffett is saying this, it is because something is about to change. This was the final warning. In this video, you will understand why this alert impacts you and your family, how to protect yourself before the crisis, and why all of this was already planned. Warren Buffett rarely issues alarmist warnings. For decades, his philosophy has been clear: buy good companies, remain calm, and never bet against long-term growth. But in his last speech as CEO of Berkshire Hathaway, he broke that pattern, and his words leave no room for doubt. The value of the currency is a frightening thing. Buffett is not reacting to news. He is responding to a structural risk that few have the courage to articulate. The same man who has defended the United States for over 70 years now chooses to move billions out of the dollar. This was not for diversification. And when someone with the track record and calmness of Buffett makes such a decision, any investor who values their money needs to stop and pay close attention. Many people still believe that economic crises are accidents, calculation errors, isolated mismanagements. But the truth is much more uncomfortable. Crises are part of the machinery of the current fiduciary system. Since we abandoned the gold standard, the money we use, whether it is the dollar, the euro, or the Swiss franc, is no longer backed by something physical, but by trust. And trust, as you know, is a volatile resource. Buffett identified this risk back in 2003. At the time, he wrote that the dollar was heading towards continuous devaluation. Few listened. The result? The so-called lost decade. Between 2000 and 2010, American stocks virtually had no real return. The appreciation of stocks barely surpassed the fall in the dollar's value due to inflation. But this was not an anomaly. It was the cycle operating as it always does. It works like this. The dollar strengthens during periods of growth. Then the American government excessively indebts itself. Confidence in the currency begins to waver, and gradually it loses value. We are seeing exactly this again, and with even more extreme data. It is easy to think that the fiscal problems of the United States are an internal matter. However, this would be a serious mistake, especially for European investors. Today, a significant portion of individual wealth in Germany, Austria, and Switzerland is exposed to the dollar, whether through global ETFs, private retirement plans with international allocation, or even institutional pension funds. European capital is strongly linked to American assets. And here is the key point. When the dollar loses value, the assets tied to it also lose real purchasing power. Even if an American stock increases in dollars, it may still be worth less in euros. Have you ever wondered how much of your return may be eroded by currency movements? Furthermore, the loss of confidence in the dollar creates instability in global capital flows. This puts pressure on the euro, distorts trade balances, and increases systemic risks here as well. There is also a detail that few mention. European central banks still hold substantial reserves in dollars. A decline in value can directly impact the monetary policy of the central bank, and indirectly, interest rates and inflation in the Eurozone. Therefore, this is not an isolated American crisis. It is a potential reconfiguration of the global financial system. And when such a change occurs, those who understand the international dynamics gain an advantage. The question is your strategy prepared for this? Most investors have heard of the United States debt. However, few understand who really finances this debt and why it represents a global risk, not just an American one. Today, countries such as Japan, China, and even Germany are among the main holders of American Treasury securities. These securities are, in theory, considered safe, but the safety depends on a critical condition: that these countries continue to purchase them. What if they stop? If Japan or China decide to reduce their exposure, the United States will have only two alternatives: raise interest rates to attract buyers or print more money. Neither of the options is harmless. The first option makes credit more expensive worldwide. The second devalues the dollar and accelerates global inflation. Now, pause for a moment and think. Why would Warren Buffett, at the age of 93, move billions from Berkshire to Japan in Japanese yen? Because he understands that monetary stability is changing location. And perhaps the average investor should pay attention to this silent, yet highly strategic movement. What will happen when the global appetite for American debt decreases? And who will finance the lifestyle of a country that has spent more than it earns for decades? These are the questions that Buffett is already answering with actions. Actions he is taking now to protect himself from the crisis he knows is coming. This video is not about predicting disasters. We are not here to instill fear, and Buffett has never operated that way. The objective is different: to give you rational tools to deal with risks before they materialize. Buffett does not react to crises, he anticipates them. By doing so, he always follows a set of principles that have proved effective for more than 60 years. This is what we call a playbook, a set of tactical actions, tested and adaptable, to navigate uncertain moments without losing emotional or financial control. And here is the best part. This playbook can be perfectly adapted for the average investor like you and me, even on another continent. It is not necessary to have billions in capital or access to global companies. What is required is logic, discipline, and a long-term vision. In the next few minutes, you will learn about the 3 tactics that structure this strategy, and more importantly, how to apply them now, with the assets and resources you already possess. Tactic 1. Diversify beyond the dollar and the euro. The current monetary system is based on something intangible: trust. And when that trust wavers, whether due to excessive debts, persistent inflation, or political instability, the value of fiat money begins to slip through your fingers. That is why Buffett withdrew billions of dollars from the United States and bought shares in Japan in yen. He is not just diversifying geographies, he is protecting himself from a systemic risk, the deterioration of currency. But how can the European investor do something similar? First, by investing in international ETFs with exposure to Asia and Latin America, especially those with currency hedging, which reduce the impact of the depreciation of the dollar or the euro. Investing in good businesses is also a form of protection. Solid companies that generate profits and pay dividends. The largest companies in the sector adjust the prices of their products and services year after year to at least keep up with inflation. This maintains profit margins. The same upward trend usually occurs in dividend payments, which have been growing for consecutive years in these companies. They protect the investor from inflation while delivering growth. Buffett has always said, prefer productive assets over speculation. And this is a lesson that holds true both in Omaha, where he was born, and here. But that alone is not enough if you want to completely escape inflation, because you would still be tied to the fiat system. For that, you can use precious metals, such as gold and silver, for example. They have over 5,000 years of history as a store of value. They do not depend on central banks, cannot be printed, and continue to be sought after in times of uncertainty, like the current one. Or Bitcoin, which has the same role but follows a different logic. It is digital, scarce, decentralized. In times of shaken trust in traditional currencies, it grows as an alternative for protection, especially for those who understand its true value and function. Now, protecting oneself is one thing, but what if you want to turn this preparation into opportunity? Tactic 2. Accumulate liquidity with an offensive purpose. Currently, Warren Buffett is sitting on a pile of over 340 billion euro in cash. Not because he fears a market collapse, but because he knows that when everyone panics, he will be ready to act. And for the average investor, especially in Europe, the principle is the same, only the scale changes. Having liquidity does not mean staying out of the market with idle money. It means having room to maneuver. And this starts with simple yet powerful actions: reducing non-essential expenses, cutting waste in the household budget, and adjusting your lifestyle to the economic reality that may be coming. All of this with the aim of accumulating cash to protect against potential problems in case you do not yet have an emergency fund. Or do like Buffett and take advantage of the opportunity to buy when the whole market is down. Does that seem conservative? It might be. But it is precisely this conservatism that allows you to act when prices plummet and quality assets are undervalued, with discounts reaching up to 80%. The ideal reserve should be in high liquidity and low risk assets, like interest-bearing accounts, German government bonds, or short-term fixed income funds. And here comes a neglected point. This preparation should include the entire family. What is the point of saving if household expenses continue to rise. When everyone understands the plan, discipline multiplies. What was once a counterforce to your savings becomes an accelerator. Have you talked to your family about this? Because when the next crisis arrives, and it will arrive, the difference between stability and despair will lie in the level of preparation done today, not in the reaction to be taken tomorrow. And this is what the next tactic is about. Tactic 3. Maintain discipline. Despite all the risks he pointed out, Warren Buffett did not sell everything. He remains invested in American stocks, but made adjustments. He increased cash, reduced exposure where data showed fragility, and reinforced positions in strategic assets. This is the true secret: discipline. It is not about predicting the next market move. It is about sticking to the plan, adjusting based on data, and resisting the temptation to act impulsively. You do not need to stop investing. On the contrary, continuing your contributions to global ETFs, consistent funds, and fundamentally strong stocks is essential, especially in uncertain times when many retreat and the best opportunities arise. Money is an infinite game. You do not win by accumulating X euro. You win by staying in the game with intelligence and consistency. Buffett has been investing for over 60 years, has navigated wars, bubbles, currency crises, and inflation shocks. And his greatest advantage has never been luck. It has been a cold-blooded strategy. This is exactly what you can do now. Following the simple strategies we shared in this video does not require genius. It only requires clarity and action. And let's be frank, easier than this is just doing nothing. But in that case, the bill may come due, and regret is usually expensive. If there is anything that this Buffett alert teaches us, it is that the time to prepare is not when the crisis has already begun. It is now. So, are you willing to keep playing, or will you let the system decide for you? Warren Buffett has always acted with logic, never with fear. His latest warning is simple: prepare yourself before confidence runs out. Reduce exposure to the system. Protect your assets and your family. If this makes sense to you, subscribe to the channel, leave a comment on what you are already doing, and share it with those who are still unprepared. Crises test the unprepared, but reward the patient. We will see you in the next video.